Hello my dear students, welcome everyone for this CFR revision series. Now in this session, we are going to revise Accounting of Financial Instruments chapter. Examination point of view, very important. Definitely you can get one question as well as one or two MCQs from this chapter. So let us start revising Accounting of Financial Instruments. So there are three Indias dealing with accounting of financial instruments. Ind AS 32, Ind AS 109, Ind AS 107. Ind AS 32 talks about presentation of financial instruments. Ind AS 109 talks about recognition and measurement of financial instruments. Ind AS 107 basically talks about disclosure relating to financial instruments, which is a complete theory part, so you can skip it. So the major Ind AS to be focused relating to this chapter is Ind AS 32 and Ind AS 109. So first of all, what is financial instruments? See, financial one word, instruments another word. Usually financial word is related to money, finance. When we talk about money or finance, we use the word financial. Instrument means a tool which is created to achieve a specific purpose. So here, to achieve any financial goal, specific financial goals, or to facilitate financial transactions between the parties or manage financial transactions between the parties, generally they create certain kind of instruments. Those are technically called as financial instruments. But this is a layman way of understanding what is financial instrument. Let us understand what is financial instruments in the language of Ind AS 32. So Ind AS 32 says financial instrument is a contract that give rise to financial asset to one party, financial liability or equity instrument to another party. So basically how financial instruments are created, there is a contract between the parties and this contract has given financial asset to one party, financial liability or equity instrument to another party. So now we need to understand what is financial asset, what is financial liability and what is equity instrument. Because to become financial instrument, the contract must give rise to financial asset or financial liability equity instrument, any one of it. So now it is very important to understand what is financial asset, financial liability or equity instrument. So let us first discuss what is financial asset. So basically standard has given a definition, sir. So point wise they have given. So what are financial assets? They are saying that financial assets are cash. So cash is a financial asset. And next one, equity instrument of another entity. That means investment in equity shares of another company. Suppose if X Limited have any investment in the equity shares of Y Limited, so X Limited point of it's a financial asset. Equity instrument of another entity, like investment in equity shares. And third one, if there is a contractual right to receive cash or another financial asset. So in accordance with the contract, if one party has the right to receive cash or another financial asset, that becomes their financial assets. Example is debtors, loans given, so bills receivable, investment in debentures, investment in bonds. So these are all what? A contractual right to receive cash. For example, X Limited sold goods to Y Limited. Now from Y Limited, we have a contractual right to receive cash. Or suppose X Limited has given a loan to Y Limited. So X Limited point of view, loan is receivable in the form of cash. Okay, so like this. So any contractual right to receive cash, sometimes any other financial asset, not only need not required to be received in cash, in any another financial asset. Okay, and or contractual right to exchange financial assets or liabilities under potentially favorable conditions. So if I entered any contract, in accordance with that contract, if I have a contractual right to exchange any financial asset or liabilities under potentially favorable conditions, they will also become my financial assets. So here the best example for this is options and futures. options, futures. So basically these three will become financial assets. Of course, there is a fourth point also, but this point is not relevant in Indian context. So therefore, you can ignore this point. So what will become financial assets? 3 points you have to remember. But in the third point, there are two possibilities, A or B, any one. So financial assets are cash, equity instrument of another entity, contractual right to receive cash or another financial asset, or exchange financial assets or liabilities under potentially favorable conditions. So let me give you one example from my notes, so which I have taught in the classroom. So the best example for this is, suppose there is a company A Limited which has entered a call option contract to purchase equity shares of B Limited for rupees 100 per share at the end of 60 days. So there is a company A Limited, sir, though they have entered a call option contract with B Limited. What is generally call option calls? So call option, put option, they say. Call option means purchase. So A Limited entered a purchase agreement to purchase equity shares of B Limited for 100 rupees at the end of 60 days. Now this is a kind of a contract. Now you tell me, after 60 days, so A Limited point of view, if the price is more than 100, if the share price of B Limited equity share is more than 100, then A Limited is in a disadvantageous position, right? Because A Limited has entered a contract to purchase each share at 100. So irrespective of the market price after 60 days, B Limited now under the obligation to sell the equity shares to A Limited at 100 rupees. So as a Limited, I already entered a contract to purchase the shares of this B Limited after 60 days at rupees 100. Now after 60 days, if the price is more than 100, now it is potentially favorable to me. As a Limited, the conditions are potentially favorable to me. So I will give cash and I will take the shares at 100 rupees only. Suppose after 60 days, the price in the market is 125. So being a Limited, this share right now trading at 125 in the market, but I entered a contract to purchase this share at 100 rupees. So therefore, straight away 25 rupees profit for me. If I purchase the share at 100 rupees and sell it at 125, 25 rupees is a potentially favorable, potentially profit for me. So A Limited. So standard says, if there is a contractual right to you to exchange any financial asset or liability, in this case cash you are exchanging for shares. So see, you will give cash, other party will give you shares. So that will become your investment in equity shares of B Limited. And you can exercise this contract when it is potentially favorable. See here, favorable conditions. So see, A Limited point of view, favorable conditions. B Limited point of view, unfavorable conditions. Suppose B Limited point of view, you think B Limited, irrespective of the price, they have to sell the share at 100 rupees only to A Limited. They are under the obligation. So for them, it becomes a financial liability. For A Limited, it becomes a financial asset, because the standard says any contractual right to exchange any asset or liabilities under potentially favorable conditions. So the best example could be options and futures. So they are called as derivative contracts. Basically, what derivative contracts? So if any enterprise has entered a derivative contract, and if under the derivative contract, if there are potentially favorable conditions for me, so as a holder of that option, then I can treat them as my financial assets. See, in this case, A Limited is called holder of the option. B Limited is called writer of the option. Both of them entered into a contract. Okay. So, sir, what is derivative contract? See, in this standard, sir, lot of times you hear the word derivative, non-derivative. So let me discuss what is derivative contract. So to put it simply, to become a derivative contract, three conditions must be satisfied. One is there must be an underlying asset in the contract. In this example, what is the underlying asset? Shares of B Limited is the underlying asset. And settlement in future. When this contract is going to be settled in future after 60 days in our example. And initial payment is zero or negligible. Is there any payment exchanged between the parties initially? No, zero or negligence. So if all the three conditions are satisfied, we call it as a derivative contract. There must be an underlying asset, there must be settlement in future, initial payment is zero or negligible. If all these three conditions are satisfied, such kind of contract is called derivative contract. So in case of a derivative contract, so being a holder of that option, being a holder of that contract, if you can exercise this obligation under potentially favorable conditions, it will become your financial asset. Okay. Now in this case, see here, A limited point of view, potentially favorable to them, so it becomes a financial asset. B limited being the writer of the option, potentially unfavorable to them, so it's a financial liability. Okay. So therefore, this is financial asset. So can you tell me what is financial asset? Cash, equity instrument of another entity, contractual right to receive cash or another financial asset, or exchanging financial assets and liabilities under potentially favorable conditions. Now let us discuss financial liability. Very, very important. So the standard has defined financial liabilities in two ways. This is one part, this is one part. Financial liability is any liability. There is a contractual obligation. In asset, we have contractual right. Here, contractual obligation. So basically, obligation means what? Something you cannot avoid. You have to fulfill. That is called obligation. Now here the obligation is created because of the contract. See, basically obligation can be two types. Legal obligation, contractual obligation. Now standard specifically said about contractual obligation. So when anything will become our liability, as per the first part of the definition is, there must be a contractual obligation. Suppose if there is a legal obligation, it will not become a financial liability. For example, income tax payable. This is as per law. So this is a legal obligation. So you cannot call this as financial liability. Advance money. Suppose you received advance money from the other party. So when you receive advance money, you are going to receive as per the contract between the parties. So there is a contractual obligation for you to deliver the goods. That's why you received the advance from the customer. Similarly, warranty. Any warranty you give to the customers. For example, you sold the goods by giving 1 year warranty. That means what? For 1 year, if anything happened to the goods you sold, definitely you have to replace it or you do the repairs, right? So there is an obligation, and that obligation is created as per the contract. So therefore, what is financial liability? There must be a contractual obligation. There is no legal obligation. Suppose simply being only a legal obligation, it cannot become financial liability. So contractual obligation for what? To deliver cash or another financial asset. Generally, when you talk about a liability, obviously there is an outflow of amount, outflow of assets to settle it. That is what they are saying. So there is a contractual obligation to deliver cash to the other party. Example, trade payables. When you purchase goods from the supplier, you have to make the payment. So there is a contractual obligation to deliver the cash. Or loan taken from bank. For example, you taken a loan from bank, you have to pay it in the form of principal and interest. So there is a contractual obligation to deliver cash. Or similarly, any kind of borrowings. For example, you entered a finance lease agreement. Now, according to that lease agreement, there is a contractual obligation for you to pay the lease rentals. So therefore, deliver cash or another financial asset. Sometimes you are going to settle the liability by any other financial asset. Need not necessarily be in the form of cash. We have discussed the financial asset definition, na? 3 parts. So any other financial asset apart from cash, that is also okay to become financial liability. So financial liability is a contractual obligation to deliver cash or any other financial asset and exchange financial assets and liabilities under unfavorable conditions. So if you have a contractual obligation to exchange any asset, financial asset or liability under potentially unfavorable conditions, that will also become your financial liability. So in our example, A limited and B limited, A limited being the holder of the option, if conditions are potentially favorable to them, they can exercise the option. So it will become their financial asset. But B limited point of view, irrespective of the market price of the share, so they have to honor the obligation. So therefore, it is, even though it is not potentially favorable to them, it is obviously unfavorable to them. That's what I have written here, potentially unfavorable to them. So therefore, it becomes a financial liability. So the best example here is options and futures. So in case of options, futures, for one party, potentially favorable. Obviously, for another party, potentially unfavorable. See, if two parties entered into a contract here, obviously one party will exercise that option, exercise that contract only if it is advantageous to them. Now other party has to fulfill that obligation. So it is unfavorable to them. So for one party, it is asset, financial asset. For another party, it becomes a financial liability. So that is what they are saying. So this is the first part of the financial liability definition. Now the most important part is the second part. What is financial liability? See, if you read this any number of times, you don't understand. So just listen to me. So what I'm going to taught regarding here, you will easily remember. So first I'm going to read quickly a contract that will or may be settled in the entity's own equity instrument. Sometimes suppose there is a contractual obligation, you have to settle it by your own equity shares. And a non-derivative for which entity is or may be obliged to deliver a variable number of entities' own equity instrument, or a derivative contract that will or may be settled other than by exchange of fixed amount of cash or another financial asset for a fixed number of entities' own equity instrument. So basically what they are saying here. Let me give you the simplified version I have given in the notes. So look at this chart. So very, very important. Suppose, sir, you entered a contract. Sir, we are discussing what? The definition of financial liability. See, suppose you entered a contract. Under that contract, you need to settle the other party. Okay? And you promise that you are going to settle it by issuing your own equity shares. Now, whether the liability under the contract you are going to settle it by issuing your own equity shares, are you going to settle by, are you going to treat it as your financial liability, or are you going to treat it as your equity shares, equity instrument? That is the question. So we are discussing the definition of financial liability. Okay. Now the standard says the contract what you have entered, what is the nature of the contract? Is it a derivative contract or is it a non-derivative contract? You have to see. Suppose, sir, if the contract is non-derivative contract and if the contract is a derivative contract. So first of all, what is a derivative contract? What is non-derivative contract? Just now I told, to become a derivative contract, first of all, in that contract there is an underlying asset and the contract must be settled in future and initial payment is zero or negligible. That is called derivative contract. Options, futures, forward contracts are the best examples. Non-derivative contracts means there is no underlying asset. Like for example, we have taken a loan from a bank. So that means it's a contract between the company and the banker. And how you are going to settle it? By paying cash in the form of principal and interest. There is no underlying asset, right? So that is called non-derivative contract. So basically non-derivative contract is a plain contract. It does not involve any asset. So in our example A Limited and B Limited, that's a derivative contract because there is an underlying asset, that is equity share of B Limited. But it is not the case in case of a non-derivative contract. Now the standard says you entered a contract and that contract you are going to settle it by issuing your own equity instrument, and if that contract is non-derivative contract, then you have to see or you have to apply one test called fixed test. Apply fixed test. What is this fixed test? If you are going to settle the obligation by issuing fixed number of shares, then treat that liability as equity instrument. Treat that as equity instrument, not as financial liability. Very interesting. So basically what students thought is, so if something is settled in the form of equity shares, a liability is going to settle in the form of equity shares, obviously we have to treat it as liability only. But standard says no. If the contract is non-derivative in nature, you apply fixed test. If the number of equity shares to be issued is fixed in nature, then you treat that as your equity, not financial liability. So this is the point. Suppose if you are going to settle that contract by issuing a variable number of shares. Variable number of shares means you don't know how many shares you are going to issue. Now in such a situation, treat that as financial liability. So therefore the intention of the standard is very simple. At the time of entering into the contract itself, you know ultimately you are going to settle this contract by issuing a fixed number of equity shares. Then better you treat it as equity instrument. If the number of shares to be issued is not fixed, you are going to settle it by variable number of shares, then you treat it as a financial liability. And that if the contract is non-derivative in nature. Non-derivative in nature. And suppose if the contract is derivative contract, then you have to apply fixed for fixed test. You are not required to remember these names, but main condition you have to remember. Fixed for fixed test. Sir, what is this fixed for fixed test? Simple. Under the contract, under this derivative contract, you are going to settle the other party. How much amount you are going to settle? How many shares you are going to issue to settle that? Because basically what I said, there is a contract. That contract you are going to settle it by issuing equity number of shares. By issuing shares. So if the amount to be issued and the number of shares to be issued, both are fixed, then treat it as equity instrument. Only one is fixed or none is fixed, financial liability. So remember, very simple, fixed for fixed test. Two things fixed, equity. One is fixed, none is fixed, liability. So basically the intention of Ind AS 32 is very clear. If you are settling any liability by issuing equity instrument, you are going to issue fixed number of shares. In case of a non-derivative contract, treat it as equity instrument only, equity only, not financial liability. If it is a derivative contract, because in case of a derivative contract, the value is depends upon the underlying asset. The price of the underlying asset will move the contract, will decide the contract. That's why you need to apply fixed for fixed test. So therefore you have to see how much consideration I need to pay to settle this liability and how many shares I need to issue. Both are fixed here, then equity. See, if anything, everything is known in the beginning itself, everything is fixed, na. So better you treat it as your equity only, because you know how much amount I need to pay, how many shares I need to issue. Equity instrument. Sir, I don't know, sir. I don't know the amount. Or I don't know, I know the amount, but I don't know how many shares I am going to issue. Or I don't know, sir. This contract, only at the end, I know how much amount I need to pay to the other party, how many shares I am going to issue. Nothing is fixed, sir. Then liability. Because everything is fixed, na, equity. So that is the intention of the standard. So the meaning of this paragraph is this. So you simply remember this, you will understand. Okay. So this is financial liability. So if you observe deeply, sir, in the financial liability itself, we have touched one point relating to equity also. So next definition, what we are going to discuss is equity instrument. Sir, what is equity instrument? Generally nothing but shares of the company, equity shares of the company. So an equity instrument is any contract that evidences the residual interest in the assets of the entity after deducting all of its liabilities. Assets minus liabilities, net assets. Actually, who is having vested interest in the net assets of the entity, sir? Owners of the property, right? Nothing but shareholders. So when we call anything as equity instrument, because three things, financial asset, financial liability, equity instrument. We understood what is financial asset. We understood what is financial liability. Now we need to understand what is equity instrument. So to put it simply, anything which is not satisfying the definition of financial liability can be considered as equity instrument. I will explain in a very simple manner. You see, we have seen the financial liability definition. Na? What is the first part of the financial liability definition? So financial liability is a liability. There is a contractual obligation to deliver cash or another financial asset, or exchange of financial assets or liabilities under potential unfavorable conditions, then it becomes a financial liability, right? So if I add word no contractual obligation either to deliver cash or any other financial asset, or exchange of financial asset or liabilities under unfavorable conditions. There is no contractual obligation at all. There is no contractual obligation for us. No contractual obligation. Or this one we know when it becomes a financial equity instrument. If the contract you entered and you are going to settle that contract, and if it is a non-derivative contract, and if the number of equity shares to be issued is fixed, then equity instrument. Derivative contract, the amount you are going to pay, the number of shares you are going to be issued, both are fixed, treated as equity instrument. So that's it. This is the definition of equity instrument. So there is no contractual obligation either to deliver cash or another financial asset, or to exchange financial assets and liabilities under unfavorable conditions. So that means financial liability first part not satisfied, obviously it becomes equity instrument. Or settlement, how you are going to settle it. So suppose I entered a contract. According to that contract, I need to settle the other party by issuing my own equity instrument. When I need to treat it as my equity instrument. Non-derivative contract, apply fixed test. The fixed number of shares I am going to issue, equity instrument. Derivative contract, apply fixed for fixed test. That means two things must be fixed, the consideration and the number of shares. If both are fixed, I need to treat it as equity instrument. So that means we have completed the discussion of financial asset, financial liability, equity instrument. Now there is a small concept called puttable instruments. What is this puttable instrument? See, suppose if an entity issued any instrument giving an option to the holder that anytime if he wants he can sell it back to the company. So anytime if he wish, he can give it back to the issuer. That is called portable instrument. Now, basically, suppose a company issued these kind of portable instruments, company will treat them as financial liabilities. You have to remember this, financial liabilities. Why? Because we are giving an option to the holder that anytime if you want, he can return it back to the company. So company has to discharge them. So that's why company point of view, generally they will be considered as financial liabilities. So give the holder the right to sell the instrument back to the issuer. Maybe automatically return to the issuer due to uncertain event or holder's death or retirement. Any unforeseen circumstances happen. So being suppose a holder died or because of his retirement, he can return it back to the company. Company will take the financial instrument and give the money back. That is basically a financial liability. But here one important point, sir. The portable instrument which is issued by the company is giving the holder the right to participate in the net assets of the company at the time of liquidation, like equity shareholder. So who has the right to participate in the net assets of the company at the time of liquidation? Generally shareholders, right? Being a owner. Now, however, if they entitle, the portable instruments entitle the holder a pro rata share of entity's net assets upon liquidation, they are classified as equity. So they can ask an MCQ. Portable instrument, generally financial liabilities. But when they can be treated as equity, if the holder of the portable instrument has the right to participate in the entity's net assets at the time of liquidation, like shareholders, so they will be treated as equity. Some examples could be convertible bonds with put options, employee stock options with put futures, mutual funds with redemption rights. These are all examples. So this is Ind AS 32. So we have completed. So Ind AS 32 basically talks about what? Presentation of financial instruments, financial asset, financial liability, equity instrument. Now, the second part, which is very, very important part. Ind AS 109. Sir, basically Ind AS 109 talks about what? It talks about classification and measurement of financial instrument. Basically, accounting treatment of financial instrument. Because of financial instrument, a financial asset created for one party, financial liability or equity created for another party. Now, how they are going to do the accounting of financial assets and liabilities and this equity? Now, see, listen. Ind AS 109 has classified financial assets, financial liabilities. After classification, they have provided at what value they have measured in the books. So this classification and measurement is very, very important, sir. Now, listen. When I talk about financial assets, standard has classified them into three categories. Amortized cost, AC, amortized cost. Second one, FVT OCI, fair value through other comprehensive income. Third, FVTPL, fair value through P&L account. So financial assets classified under any one of the following: amortized cost, fair value through other comprehensive income, fair value through P&L account. Okay. Sir, when financial asset is classified under amortized cost model, when any financial asset is classified under FVT OCI model, when financial asset is classified under FVT PL model, of course I will tell, wait. Now, when it comes to financial liability, sir, only two classification. Amortized cost model AC, first one. Second one, FVT PL model. That means fair value through profit and loss account model. FVT OCI is not there for financial liabilities. So you remember, financial assets are classified under AC model, FVT OCI model, FVT PL model. Financial liabilities are classified under AC model, FVT PL model. Okay. See this chart. This is very, very important, sir. Classification, first financial assets, amortized cost model, FVT OCI, FVT PL. When it comes to financial liability, AC model, FVT PL model. Equity, there is no such classification. Okay. Sir, what is the basis of classification? when we classify any financial asset as under amortized cost model. See, BM test to collect, SPPI test. BM test, SPPI test. There are two tests. BM test means business model test. First test. Second test, SPPI test, that is solely payments of principal and interest test. If both the tests are satisfied, BM test to collect and SPPI test, then that kind of financial asset is classified under AC model, amortized cost model. Because see, when you want to do the accounting, first you need to classify it will belongs to which model, it belongs to which classification. So that's why this classification is very, very important. So BM test to collect, SPPI test. If both the tests are satisfied, amortized cost model. Now come to FET OCI model. BM test to collect and sell. What is the difference? Here only collect, no sell. Here collect and sell, and SPPI test. If BM test to collect and sell both satisfied and SPPI test is also satisfied, then such kind of financial assets are classified under FET OCI model, that is fair value through other comprehensive income. Now suppose if any financial assets like investment in equity instrument, if they are held only for trading, that means both the tests failed, BM test as well as SPPI test failed, then they will be classified under FETPL model. So tell me, when financial assets are classified under AC model, amortized cost model, so BM test to collect and SPPI test both must be satisfied. When financial assets are classified under FET OCI model, BM test to collect and sell as well as SPPI test, both tests must be satisfied. Now suppose either BM test or SPPI test failed, or to put it simply, any assets, any investments, any financial assets held just for trading, then they will be classified under FETPL model. FETPL model. This is about financial assets. Now let us discuss what is BM model. Sir, BM business model test means simply, see with what intention you are holding the financial assets. Suppose you made investment in the equity shares of another company. So with what intention these investments you are holding? Because equity instruments of another entity is your financial asset. With what intention you are holding it? So suppose some investments, some assets we held only to collect, Assets are held primarily to collect contractual cash flows, interest and principal. For example, we have given a loan. Now, or for example, we invested in the bonds, debentures. Now our intention is to collect the interest as well as principal. That means BM test only to collect that asset, your investment in the bonds, your investment in the debentures, or your investment in equity shares, only to collect what? Interest and principal. Generally equity shares will not give you interest. So debt securities I can say. So if your financial assets are held primarily to collect the contractual cash flows, just to collect the interest and at the end principal, that is called held to collect. That means if any investment you held it only to collect, BM test to collect, you just want to collect the cash flows and principal, you don't want to trade that investment. And some investments are you held to collect and sell. That means you are holding those investments and you want income, but at the same time if you get a good price you want to ready to sell it. So assets held both collecting cash flows and selling them for liquidity management or other purposes. See, some entities will hold the investments, whenever they want they can sell it, and meanwhile they can earn profits they can enjoy the returns from those investments. That is called BM test to collect and sell. See, the difference here is only to collect, we don't have the intention to sell. So suppose if I have the intention to collect as well as sell also, that is second one, BM test to collect and sell. Now some investments only for trading. Suppose we made investment in shares only for trading purpose. So we don't want to held it for, collect the cash flows. Then obviously it will comes under FETPL model. So that's it. So BM test means with what intention you are holding the assets. Your intention only to collect the cash flows from that asset, or your intention is to collect the cash flows as well as sell it in the near future. So then it is called BM test to collect, asset held to collect as well as sell. Then trading purpose. Now what is SPPI test? solely payments of principal and interest test. So assess if the cash flows from the financial assets are only payment of principal and interest. To pass the test, the cash flows must represent the basic lending terms, principal repayment and interest based on the time value of money, credit risk, etc. So if the cash flows are linked to variables like equity returns or commodity prices, as they introduce additional risk or volatility. That means solely payments of principal and interest. That means your assets ultimately realized in the form of cash only. You don't want to, if that contract has any other payment terms other than cash. So if the cash flows are linked to variables like equity returns or commodity prices, that means if they are linked with any other thing, like for example, suppose in our example A Limited, B Limited. Now A Limited wants to purchase the shares of B Limited. Now the actually whether the contract will be exercised or not, that depends upon the share price, right? For example, A Limited has entered a contract with B Limited to purchase the oil. After 6 months, at so and so on price. Now the thing is that the price of the oil in the market may fluctuate. So that will ultimately going to affect my price. So it should not be like that. SPPA test means solely principal and interest test. That means the payment, the cash flows are linked to variables like equity and commodity prices. So they will introduce additional risk and volatility. Then SPPA test is failed. So that means it is basically SPPA test means solely that asset must be realized in the form of cash only. Okay, that's why they are saying that assess if the cash flows from the financial assets are only payment of principal and interest. So only we have to get principal and interest. So to pass the test, cash flows must represent the basic lending terms must be there. That is principal repayment and interest based on time value of money, credit risk. When we say there is a failure of SPPA test, if the cash flows are linked to variables like equity returns or commodity prices. Suppose so instead of cash, they may want to give equity, or they may the price, the cash flows is subject to changes, commodity prices. Then we say that this SPPA test is failed. Okay. So this is the classification of financial assets. Now coming to financial liabilities, sir. So understand, sir, the standard says when it comes to financial liability, there are only two models. One is amortized cost model and another one is FVTPL model. When amortized cost model, generally the default method is amortized cost model in case of a financial liability. And any other financial liability will be classified under FVTPL. Suppose if any liability is held for trading, or if entity elects FVTPL model, then obviously they will be classified under FVTPL. So any financial liability, generally it will come in which model? AC model, amortized cost model. And if they specifically given in the question that it will comes under this FVTPL model, then you take it under FVTPL model. Or if any financial liability is held for trading purpose, then FVTPL model. Then equity, there is no such thing. So therefore, whenever you want to do the accounting of financial instruments, first what you need to do, sir, you need to do the classification. Financial assets are classified under three categories: amortized cost model, FET OCI model, FETPL model. Financial liabilities are basically classified under two models: amortized cost model, FETPL model. Okay. Now, once you classify financial assets and liabilities under the respective models, depending upon the terms and conditions, next thing is initial recognition. So under each model, at what value initially that financial asset and liability will be recognized. So the golden principle in case of financial instrument is initially any financial asset, financial liability or equity will be recognized at a fair value. Tell me, what is the initial measurement criteria of financial instrument? Whether it is financial asset or financial liability or equity instrument. Tell me what is that? Fair value. So you look at this initial recognition: fair value, fair value, fair value, fair value, fair value, fair value. So the golden principle is fair value. Okay, but suppose you are recognizing financial asset under amortized cost model, fair value subject to plus or minus transaction cost. Any transaction cost will be added or minus, adjusted. Transaction cost will be adjusted. Similarly, here also transaction cost will be adjusted. But under FVTPL model, that means any financial asset held for trading, then transaction cost will be ignored. Generally, transaction cost will be charged to P&L account. It should not be part of the initial recognition of the financial asset. So this is very, very important. You see, under any financial asset, under AC model, FET OCI model, if you classify any financial asset under any one of these models, transaction cost should be part of them. Transaction cost should be adjusted. But here transaction cost should not be adjusted. Under which model? FETPL model. Similarly, when you come to financial liability, any financial liability, fair value subject to transaction cost. Subject to transaction cost. But FETPL don't consider transaction cost as a part of initial recognition of the financial liability. You remember this, there can be a bit coined on this. So please understand, any transaction cost should be ignored. Under which model? FVTPL model, both for financial asset as well as liability. But for financial asset under AC model, amortized cost model, initially it will be recognized at fair value subject to transaction cost. Generally, when you purchase any investment, any stamp duty, any brokerage we paid, we will add same manner. Here transaction cost, it should be added generally. In case of financial asset, in case of financial liabilities, transaction cost will be deducted like that. But if you are classifying financial asset and liability under FVTPL model, then transaction cost should not be included as a part of financial asset or financial liability. Okay. So initial recognition is over. So initially, first time when you want to recognize any financial asset, you will recognize it fair value, but subject to transaction cost. In case of financial asset, AC model, FET OCI model. FETPL model, only fair value. Transaction cost will be ignored. It is treated as normal expenses and charged to P&L account. When it comes to financial liability, only two models, AC model, FET OCI model. AC model, amortized cost, model, fair value subject to transaction cost. But FETPL model, ignore transaction cost. Of course, equity will be initially measured at fair value. Now, subsequent recognition, sir. Sir, once initially any financial asset and liability is recognized, on the balance sheet date, that is subsequent recognition at what value? See, subsequent recognition, amortized cost in case of AC model. In case of AC method, if you classify any financial asset under AC model, amortized cost model, then subsequent measurement will be done at amortized cost. Then, what about FET OCI financial asset? Fair value. Again, fair value at the end of the year, whatever be the fair value is there, at that fair value. And FETPL, fair value. When it comes to financial liabilities, same, amortized cost model, amortized cost. FETPL, fair value. And in case of equity, no subsequent remeasurement. Important. There, except AC model, everything is fair value, sir. That is the thing you need to remember. So that's why here, if you observe the questions, the more questions they're asking only from AC model. Because the remaining things they have to mention. Suppose if they have asked a question relating to FET, OC, fair value through other comprehensive income or FETPL, they should specify in the question. But amortized cost is the default model. So you have to, if nothing is mentioned, you have to follow amortized cost model. Okay. So that means this is the thing. So financial assets classification, financial liabilities classification, initial recognition, subsequent recognition, I have covered. Now, so I have taken one example also. For example, see amortized cost model. For example, we purchased a bond, sir. Face value 1 lakh, cost 95,000, transaction cost 2,000. Coupon rate, that means the rate of interest 5%, term 3 years. Redemption, fair value plus premium on redemption 5,960 we will get. Now, in amortized cost model, how initially the financial asset will be recognized? Tell me. Fair value subject to transaction cost. See here. So financial asset, I am recognizing in my books to bank because asset, right? Asset to bank. 95,000 is the cost plus transaction cost. Whenever I acquire any asset, any transaction cost will be added. So added back. Okay. Now the most important thing is, in case of amortized cost model, I need to calculate EIR, effective interest rate. That is nothing but internal rate of return I need to calculate. Then it is not the coupon rate. Suppose I made investment in bonds, I am going to get 5% interest. But that is not my income, that is only the return I am going to get from the person with whom I made the investment. So I am going to get 5% interest on 1 lakh face value bond, 5,000. But what is my income? For the purpose of income, I need to calculate EIR. The standard says we need to calculate effective rate of interest. That is internal rate of return. Why? Because see, I am purchasing at 95,000 and there is a transaction cost. And at the end, there is a redemption also, premium on redemption also. So therefore, this 5% is not the actual return I am going to get from this financial asset. That's why I need to calculate one internal rate of return. Okay, by applying the concept of interpolation, I need to find out effective interest rate. So by what is the effective interest rate? Suppose if I calculate 8% I got. So time value of money, concept of interpolation, present value of inflows, present value of outflows. So 8% I got. Now 8% is the effective rate of interest on this asset for me. Internal rate of return. So this 8%. So if I apply on 97,000 8%, my income is 7,760. But actually what I got is 5,000. So what is my closing balance? 99,760. This is not at fair value. Just now we have seen in case of financial asset measured under amortized cost model, subsequent measurement will be done at amortized cost only. So this 99,760 is the amortized cost. So next year it will be the opening balance. Again next year also I need to calculate. So my finance income. So 8% on 99,760. This 8% is not the coupon rate. We have to calculate EIR. But in the questions they will give, I am going to show you. So even in examination questions also, they have mentioned the market rate of interest. So that market rate of interest is nothing but effective interest rate. So in case of financial assets, for calculating interest, we need to use EIR, not coupon rate. At coupon rate, interest we are getting and closing balance. Like this, we need to recognize. So in case of financial assets, okay, we are under amortized cost model. So this is how we need to do the accounting. First asset will be recognized, then financial income will be added to the asset. Then out of that 5,000 is recovered. So closing balance we got. Now this closing balance will become opening balance for the next year. Again next year we need to calculate the finance income. And this is the interest I am going to recover against the asset. And this is my closing balance. Next year this is my opening balance. Again on this I need to calculate finance income. But here finance income is calculated by using effective interest rate. So that is the interesting point in this model. Sometimes FVT OCI, suppose if my financial asset, when we have to classify my financial asset under FVT OCI model, when I hold the investments, so I mean to collect the cash flows as well as sell. So maturity, sell. Whenever I want, I can sell it. And my intention is to earn income also. Then I need to classify under this. Now the same example if I take here, same 95,000 initially plus transaction cost I have added. So 97,000. Finance income same 8%, 7,760. So even FVT OCI model also I need to use effective interest rate to calculate the finance income. And this is the interest what I am going to get from the issuer of the bond. So 5,000. Now here the important thing is my closing balance is 1,01,000. Sir, this is what? This is fair value. This is fair value. They will give in the question because see in this table I told you in case of a financial asset which is classified under FVT OCI, what is the subsequent recognition value? Fair value. So fair value is 1,10,000. So the difference is 10,240. This is called change in fair value. It must be transferred to OCI. That's why this method is called FVT OCI model, other comprehensive income. Generally, you know, according to the Indian accounting standards, if there is any change in the fair value, that change can be a gain or can be a loss. That should not be directly part of P&L account. So when you prepare a P&L account, sir, once you take incomes and expenses, below that you will get profit, right? Below that there is a head called other comprehensive income. So there you need to show this. So this is the interesting point. So therefore, if I classify any financial asset under FVT OCI model, okay, any change in fair value at the end of the year, that will be transferred to other comprehensive income. So what is the difference between amortized cost model and this FVT OCI model? In amortized cost model, there is no concept of change in fair value. Why? Because we are closing the financial asset at AC only, amortized cost only. So this is the closing balance. But here in FVT OCI model, subsequent measurement will be done at fair value. So therefore, if any difference arises, in the debit side and credit side, the difference will be treated as change in fair value. That change in fair value will be transferred to other comprehensive income. And suppose if any financial asset is classified under FVTPL, so when we classify any financial asset under FVTPL, if the financial asset is held for trading, then in such a situation, initial recognition same, but you have to remember what is the interesting point there. Transaction cost should not be part of this. So therefore, initially we will recognize financial asset at 95,000 only, and subsequent measurement at fair value. So therefore, if there is any difference between the fair values, that will be transferred to P&L account. That will be transferred to P&L account. So in summary, sir, this is what you need to remember. Under amortized cost model, effective interest rate we will use. Under FVTOCI, effective interest rate we will use. Under FVTPL, no interest rate, no interest calculation. Why? Because you are holding the investment for trading purpose, short-term trading purpose. So therefore, EIR concept will not be utilized. And fair value changes. In amortized cost concept, there is no concept of fair value changes. But in FVTOCI model, yes, there is a fair value changes. So because initial measurement at fair value subject to transaction cost, subsequent measurement at fair value at the end of the year. So the difference will be transferred to OCI, other comprehensive income. But in under FVTPL model, so there is a fair value changes that will be transferred to P&L account. And same happens with financial liabilities. But in case of a financial liability, sir, AC model, FVTPL model. Initial measurement, just now I told you, fair value subject to transaction cost. But in FVTPL model, only fair value. Transaction cost will be charged to P&L account. Don't include it as a part of the fair value. And if there is any fair value changes in amortized cost model, no. Under FVTPL model, yes, it will be transferred to P&L account. EIR, yes, in AC model, no in case of FVTPL model. And in case of a financial liability, amortized cost is the default model. So therefore, this is what exactly the whole concept of this chapter, sir. Now what I'm going to do is, I'm going to show you the problems. See, quite frequently they are asking the one kind of problems. I will show you. Yes. See, this is the question they have asked in December 2023. Problem number 5. And if you see the study material questions also, similar to this question, there will be 2 or 3 questions. So this is a major question. Again and again, there is a chances that they may ask this. Okay. See here. Moon Limited issued 1 lakh 8% debentures of the face value 100 each on par value basis on January 1st, 2023. These debentures are redeemable at 12% premium at the end of 2026, or exchangeable for ordinary shares of Moon Limited on 1:1 basis. So what they have issued are basically debentures. So it's a financial liability, right? How many debentures? 1 lakh, 8% debentures. What is the face value? 100 each on par value basis when 1st January 2023. And these debentures are redeemable at 12% premium. So how they are going to redeem, sir? 12% premium at the end of 2026. That means 2023, 24, 25, 26, after 4 years. Or exchangeable for ordinary shares of Moon Limited on 1:1 basis. So they are issuing, basically they are giving an option to the debenture holder that we are going to redeem these debentures after 4 years at a premium of 12%, or we are going to exchange ordinary shares. Shares also we will give. The interest rate for similar debentures that do not carry conversion entitlement is 12%. So the debentures, similar debentures, what is the rate of interest they are carrying? 12%. You are required to calculate the value of the debt portion and the equity portion of the above compounded financial instrument. Show the journal entry at the inception of the financial instrument. So the present value of rupee 1 at the end of 1 to 4 at 8% and 12% discount rates are supplied below. First of all, this is the problem they have given. First, identify in the question whether it is asset or liability, because company issued debentures. So debenture is the liability. It's a financial liability. First thing. Second thing, financial liabilities, I told you under what are the models? What are the classification of financial liability? 2 models, AC model, FVTPL model. What is the default model? AC model. So therefore, amortized cost model we need to utilize here. Amortized cost model. Okay, tell me, under amortized cost model, look at the table, tell me, initially financial liabilities will be measured at fair value subject to transaction cost. Okay, fair value. Now what we need to do is, we need to find out the fair value. What is fair value here? Nothing but the present value of the future cash outflows because of this liability. So tell me, because of the debentures, what will be my outflows? Interest, principal. Every year I need to pay interest, and at the end of the year I need to pay principal with the premium. So therefore, what I need to do is I need to convert my outflows into the present value. So that will be my debt portion. And from the face value of the debentures, if I remove the debt portion, the remaining portion can be considered as equity instrument. Equity instrument. And now one more interesting point. Under amortized cost model, sir, we need to use EIR, effective interest rate. So what is effective interest rate here? See, we are issuing debentures, 8% debentures. This 8% is the interest what we are going to pay. But the similar debentures which will carry how much interest in the market? 12%. So this will become my EIR. So therefore, the question they have given 8% discount rate, 12% discount rate. You tell me which discount rate you are going to use. 12% you are going to use. Sir, 8% is given only to confuse you. So this 8% is the interest you are going to pay on debentures. That is not the thing you need to consider. You need to consider the effective interest rate. What is the effective interest rate? For the similar debentures, what will be the market rate? 12%. I told you in the theory discussion. Na? So definitely EIR they will give hint in the question. So based on that you need to calculate. Okay. So what you need to do now? Simple. Convert everything into the present value. See here, December 2023 question. First I need to find out the present value of the future cash flows. Present value of, sorry. So I need to find out the present value of the future cash flows at a 12%. So total debentures, 1 lakh debentures, each 100. 8% interest every year you need to pay. So that will be 8 lakhs. So every year you need to pay interest of 8 lakhs. See, first year 8 lakhs, second year 8 lakhs, third year 8 lakhs, fourth year also 8 lakhs. But fourth year along with the interest you need to pay principal as well as premium also. Premium is 12%. So these are your outflows. Use 12% discount rate. They have given in the question. See here. They will give generally. In the examination question they will give. Multiply. You will get the present value of the future cash flows. How much? 95 lakh 53,600. This will be debt portion. And what will be the equity portion? Face value minus debt portion. This is 4 lakh 46,400. And they are also asking the entries. What is the entry you are going to write here? So company point of view, whenever they issue debentures, bank account debit, 1 lakh debentures into 100. Out of that, what will be my debt portion? 95 53 600. Because India is 109 says financial liability initially debt portion will be recognized at fair value. This is my fair value. So what is fair value? Present value of the future cash flows in case of a financial liability. And remaining is my debt portion of, the remaining is my equity portion of debentures, 4 lakh 46,400. So this question they have asked, sir, for 5 marks. So very simple, na? So this is how we need to solve. And same models again, you see, first question, second question, third question, all these will follow the same thing, same pattern. And do one thing. So please solve these 4 or 5 questions. You can definitely get the concept. But here the important point is you need to focus on this table. So this table is very, very important. Based on this table only, I have explained the concept. And one more thing, sir. This effective interest rate summarized manner I have given, sir. These are very, very important. Okay. FETPL model only unique models are remaining all very simple. And remember, they will ask AC model, amortized cost model. So with this, I am wrapping up this chapter. So approximately 1 hour time it took me to discuss the entire concepts quickly. Because see, the point is, this is only a revision. So actually this chapter will take a lot of time to discuss elaborately because this is more a technical chapter. Of course, now you use this as a last minute revision. So this is only a revision, sir. In the, recorded videos, I recorded approximately, for this chapter, we have allocated approximately, 7 to 8 hours. So, but now we have completed this entire thing in 1 hour. So, because in the revision, that could, that is the time we can allocate this, because 4 or 5 marks, we can't allocate more than that. Okay. Thank you.